Hey taxpayers, 2023 is officially coming to an end, and you know what that means? That's right, tax season's just a few weeks away, and I'm feeling pretty festive. And what better way for me to close out 2023 than to, well, answer 23 of some of the most frequently asked tax questions that I get. Now, if you look down here in the video description, I'll go ahead and timestamp all the questions just so you can go ahead and jump forward to anything that's more pertinent to you. Or if you want to grab some popcorns and listen to all 23, you do you, and show off all your tax knowledge to all your friends and family at the upcoming Christmas party, so you'll be probably one of the more popular people there. Maybe. So without further ado, let's go ahead and just jump right into this. So the first question is, what is my filing status? So your filing status is actually pretty simple to figure out. Usually you can get it by just answering just a few yes or no questions. But the biggest thing is determining what was your marital status at the end of the year. And when we say the end of the year, we're talking the end of the year, December 31st, 11:59 p.m. It's just like that one Alan Jackson song. What were you when the ball dropped on Times Square during New Year's Eve bash? Were you married or were you not? I'm like 90% sure those are the lyrics. As long as you were married at the end of the year, then you only have two options. You can file jointly or you can file separately. That's it. But you might be saying, but Trey, I was a bachelor the entire year. I literally only got married on New Year's Eve. Doesn't matter. It only matters what happened on that last day. And again, if you're married, then you can do jointly or separately, and those are your only options. Likewise, if you were married the entire year and you got divorced and had like an official, again, like end of marriage ceremony or whatever at the end of the year, and you were considered single, even though you were married for the prior 364 days of the year, then you are going to more than likely file single. But let's say you are unmarried and single, but you also have a child for which you have maybe like majority custody, then potentially you can do what's known as head of household, which is, again, only eligible for people who are considered non-married. Now, head of household opens up another can of questions just to make sure that you're eligible for it. But again, what could happen is, like, if you're a single parent and you have another a child with another person that also is not married, and you share custody between the two, both of you cannot file head of household on the same child, because that's just not how the math works out. Because again, two people can't have majority custody over a single kid, because again, you can't have double majority of two separate people. It doesn't make logical sense. Also, if you were married during the year but your spouse passed away at any point during that year, even though you're technically single at the end of the year, assuming you don't remarry, you can still file as married for that year. And depending on if you don't remarry for the following 2 years after your spouse's death, you may be able to qualify as what's known as qualifying widower, which is another kind of tax status, filing for that specific situation. So again, it all really comes down to your marital status. That's usually the bigger question. But the IRS has a pretty good, like little checklist of determining what your filing status is. So if you don't know, again, just go to one of those. Usually you can figure out within, probably a minute. Next up is, what deductions do I qualify for? Well, to be completely honest, I'm not entirely sure until we go through a formal interview or consultation, or you fill out a long, questionnaire. These questionnaires are usually pretty standard in order to identify, what occurred during the tax year in question, whether it's the prior year, maybe it's the current year, maybe we're doing tax planning, maybe we're going back a couple years. Whatever, we need to know exactly what happened in that year to identify, okay, what happened that, that you'd be able to qualify for. So I feel like the days of just going up to a tax preparer, maybe just on a limb and just saying, hey, here's my W-2s, here's my 1099s, see ya, and you just walk out. I think those days are gone, because again, in order for us to make sure that we're doing your returns accurately and, providing good planning going forward, we need to know exactly what's going on, because just having W-2s and 1099s or whatever isn't going to tell us the whole story. So again, we need to ask probably a bunch of yes or no questions to see, okay, what's going on in your particular situation for us to look out for, or more importantly, what to kind of get ahead of so we go forward. It'd be like me going up to like a mechanic in the supermarket and be like, hey, what's wrong with my car? Well, the question's probably going to be, well, where's your car? I can't diagnose anything here in the middle of the soup aisle. We need to go and actually take a look and see what's going on. Same with your finances. Again, if you just ask out on a limb, hey Trey, what deductions do I qualify for? Then I'm probably going to volley back with you a bunch of questions just to make sure, again, I even know what's going on. So even though you may be considered family, or we hang out every week, chances are I still don't know everything. So again, we need to make sure we have level the playing field and see what's going on in order to make sure we do things adequately and accurately in order to, again, see what you actually qualify for. Next question is, can I deduct blank is a medical expense? Well, potentially. In order to take deductions for medical expenses, they have to be not only qualified expenses, but they also have to be paid with post-tax dollars. Which, again, post-tax is kind of the insult to injury, because one of the things that we mostly have expense-wise when it comes to our medical insurance is, well, medical insurance. So if you have health insurance through like an employer, then more than likely you're paying those through employer payroll deduction. So you're actually already paying those before you're even taxed. So in this case, probably the most expensive thing that you're probably going to incur medical-wise is going to be your premiums. But since those are usually paid with pre-tax dollars, you don't also get to take a deduction on your tax return for it, because that's considered double counting, and it doesn't really work out that way. So again, if you pay pre-tax when it comes to your premiums, they're not going to also be a deduction on your tax return. And the other criteria is they had to be medically necessary or qualified medical expenses. These are things like doctor visits, potential surgeries, prescription drugs and co-pays and so forth. But again, when it comes to medical expenses, they generally have to be non-personal and non-cosmetic in nature in order to be qualified. So for example, if I want to get a nose job so I can look more like David Hasselhoff, that would be considered cosmetic and more than likely not be considered as a potential tax deduction. But likewise, let's say I got in a really big fight and my nose was completely destroyed to the point where I could no longer breathe, and I had to get nose reconstructive surgery in order to, have a functioning nose again. Well, more than likely that's going to be considered a qualified expense, because again, it was medically necessary and it was not any way cosmetic in just strict nature. Again, there was a medical purpose for it, so again, at that point, it would be considered a qualified expense. But just in those two examples that I just made up right off the top of my head are probably gonna open up the door to, say, some gray areas, because again, certain things are considered personal, but are considered necessary, medically. So another big example would be things like, weight loss. So things like maybe vitamins or weight loss supplements are considered personal, so those would not be considered, for your medical deductions. But let's say you are morbidly obese and you are trying everything you can to, again, lose some weight. However, the doctors are saying, we need to be a little bit more aggressive. We need to start doing maybe lap band surgery or maybe doing liposuction in order to reduce enough weight to go to lap band surgery. If that's the case, then argument's sake, I would almost say that you probably do have some sort of case in order to take it as a medical deduction. But by the same token, let's just say you're overweight and you don't have like a life-threatening obesity where, again, if nothing changes, then, your life expectancy is shortly decreased, but you want to get, liposuction, then that may be considered more personal, and at that point it's not. So again, there is a little bit of a teeter-tottering you have to do in order to make sure things are considered medically necessary. Again, at that point, you usually got to have some sort of recommendation or requirement from a doctor in order for it to qualify. But again, like I said, sometimes it can get pretty wishy-washy, so it usually has to come almost on a case-by-case basis. But what a lot of people don't understand about medical expenses is that it's an itemized deduction pool. So it's not something where if you just incur it, then you automatically get to deduct it. You see, when we talk about itemized deductions, then when it comes to medical, well, it gets thrown into this pool and only certain qualified, again, if it's only gets counted towards, beneficial if it surpasses what's known as the standard deduction. So for example, if you have a bunch of medical expenses, it gets pulled into this pool. But again, if this itemized, total isn't going to be beneficial to take, then everything that you've incurred essentially goes to waste. Also, another pretty big insult to injury when it comes to medical, potential deductions is that only the amounts above 7.5% of your AGI are even counted. So for example, let's say your AGI is $100,000 and you paid out, let's say $8,000 out of pocket for other, medical expenses throughout the year that again were not pre-tax, like, employer premiums. Again, these are just out of pocket, hospital visits, ERs, and whatnot. $8,000 is quite a bit, but your AGI is $100,000, and again, 7.5% of that would be $7,500. So even though you actually had out of pocket $8,000 in payments, $7,500 of it gets automatically excluded. So only $500 is even potentially qualified to even take as a deduction. So when we look at medical deductions as potential, tax write-off, we have to look at, itemized deductions in total to see is it even worth it. And even more so, what medical deductions or expenses have you even incurred to see is it going to even surpass 7.5% of your AGI? Because if it's not, then again, anything below that threshold gets completely wiped out and ignored. And pretty much anything you've incurred to that point is, well, it's lost. It doesn't show up as a benefit on your tax return anywhere. All right, should I itemize or take the standard deduction? So this is actually a pretty good question because this is a mutually exclusive one. You can choose one or the other. This is the first time in our tax journey where we walk down a path and we have to choose some route. We can't do both, or we can't really do neither either. So obviously, since these are deductions, these are going to limit the amount of taxes that we're going to pay in terms of our taxable income. So obviously we want to choose the bigger one. So if our standard deduction is greater than our itemizing, then we want to choose the standard deduction. Likewise, if itemizing is bigger, then we want to go that route. Now, granted, again, standard deduction is going to be based off what your filing status is. There's also a little bit of bump up if you're over a certain age and if you're considered blind. However, when it comes to itemized deductions, it's a pool of just different, hodgepodge, potpourri of expenses. So again, like things like medical, things like what's known as SALT or state and local taxes, donations, just to name a couple. And again, it's the collection of all of these that have to come into play, because again, if it in total surpasses your standard, then obviously you would want to go that route. But here recently, in the past few years, everyone's standard deduction was doubled, so that's actually limited the amount of people that at least I've seen that were itemizing. So generally speaking, I'd say 90+% of the time, people would just choose standard deductions. But again, it all comes down to a case-by-case basis, because again, you want to choose which one is going to be better for you in the long run. Next up is, how can I reduce my tax bill? So this is actually a pretty complex question, because when people say their tax bill, they're usually only thinking at the very bottom number of their return. See, when you file a tax return, usually at the very bottom of the second page, or at least somewhere, it's going to give you a number. That number is going to either be positive, representing, hey, you're getting a refund, or it's going to show maybe a potential negative that says, hey, you owe us more taxes. You see, it's this number here, this amount owed, that people see as their tax bill, which is not necessarily the case, because again, a return being filed is nothing more than just a reconciliation between what we figured your tax liability to be versus your types of withholdings and payments and credits that you're eligible for. The refund just basically means that, okay, you overpaid, you're getting something back. Likewise, amount owed just means that we came up short. So for example, let's say a year or so ago you did your taxes and you had a amount due of $600. So obviously you weren't very happy because you were expecting a refund, but you had to owe $600. But let's say the following year you have someone else do your taxes and they say, okay, for this new year you're going to be owing $1,000. So you went from $600 of owed from year one or whatever, and this following year, year two, you owed $1,000. So right off the bat, you're thinking, okay, that's $400 in an increased tax bill. So obviously, whoever did the second year taxes doesn't know what they're thinking. Which again is just not the case, because again, that number is just the ending result of everything that happened before it. So again, how did your withholdings change? Did any type of credits change? Not only from that you had power of, but did tax law change, where again, tax credits changed? So for example, a good example would be the child tax credit, because from a couple years ago, it was pretty substantial, and then it dropped back down to about $2,000 per qualifying child. And a lot of people saw a big shift in what the amount that they owed, or their refunds dropped or whatnot, because again, it was tax law changes. It had nothing to do with your specific tax situation. It was just something out of your control, because it was tax law, not your income, not your qualifications or anything, just strictly the law in itself. So I think a better way to ask this question would be, how do I reduce my taxable income while also increasing any potential credits other than having to increase withholdings or estimated payments? So I think those two questions together, I think, is a little bit more, I guess, appropriate than just saying, how do I reduce my tax bill? Because we want to make sure that we're all on the same page and making sure we're all talking about the same thing. But again, I'd say, how do you reduce my income? I just think, this way would probably be a more appropriate way of asking the question, because I think it opens up, more conversations and planning, techniques and so forth. Number 6 is, what's the difference between a tax credit and a deduction? Actually, they're the exact same thing. The terms are used interchangeably. So, in this case, just choose whichever one that, rolls off the tongue and just kind of go from there. If you're going straight to the comments section to tell me I'm wrong, I gotcha. No, deductions and credits are completely separate, even though they are both, seen as good things, because again, they ultimately reduce how much you potentially have to pay out in taxes, which again, was what we all want, deductions and credits do act differently. You see, deductions occur between your total income and your taxable income. So let's say hypothetically you're a single person who makes $100,000 a year. So again, your total income is $100,000, but do you actually pay tax on $100,000? No, you're going to probably take the standard deduction. Maybe you're going to itemize. Maybe you've got what's known as above the line deductions, which are deductions that anyone can take even if they're itemizing. These are like HSA contributions, maybe a specific, retirement or so forth. But again, we want to take deductions in order to reduce our total income to what we're actually going to be paying in terms of taxable income. Once we hit this taxable income number, then we can figure out our tax liability based on our filing status from a few questions ago. Once we have this tax liability, then credits come into play. Now, credits reduce our tax liability dollar for dollar. Now, credits can also come in two versions. There's refundable credits and non-refundable credits, which sound pretty self-explanatory, but let's explain them. So non-refundable credits are going to be credits that will reduce your tax liability to zero, but any excess does not get reverted back to a refund. Whereas refundable credits, on the other hand, well, they'll reduce your tax liability to zero, and any excess gets reverted back to a refund, which, hey, sounds pretty good. So for example, let's say you had a $2,000 tax liability remaining and you're eligible for a $3,000 credit. Now, assuming that credit is non-refundable, that $2,000 tax liability gets reduced to zero, but that additional $1,000 is gone. It's given up, it's extinguished, it's kaput. But hey, we no longer have to pay tax liability. But same situation. Let's say you had $2,000 worth of tax liability, you had a $3,000 credit on deck, which was refundable. That $2,000 gets reverted down to zero. Awesome. But that $1,000 excess gets reverted back to a refund back to you. All in all, if you're going to compare deductions and credits, again, dollar for dollar, generally you would want to go for the credits because, again, those are going to be a dollar for dollar reduction of liability, whereas deductions only help you to the extent of whatever tax rate you're in. So if you have a $1,000 deduction and a $1,000 credit, whether it's refundable or not, again, this $1,000 credit is going to be worth $1,000 when we look at everything in total. Whereas the $1,000 deduction, assuming you're in the, let's say, 12% tax bracket, this $1,000 deduction is only going to be worth $120 because, again, once we reduce our income to get to the taxable income, that $1,000 gets removed, which again at 12% is only $120 in the end. So again, the credits are usually worth more and are more apt to, again, pursue. But again, that doesn't mean don't ignore any deductions because take whatever you can get that you're eligible for and, well, pay less tax than overall. Ooh, number 7, can I file exempt on my W-4? Now, keep in mind, we're talking about a W-4, which is very different than a W-9, which is very different than a W-2, which is very, very different than a W-2. You see, a W-4 is a form that you're generally going to only see once whenever you start a new job. It's a form that's usually given around the first day of your employment that just says, hey, what do you want us to withhold? Now, usually the consensus is that people like to claim 0, which basically means you're holding more out per paycheck, which means your paycheck is going to inherently be lower. But at the same time, you're more likely going to get a refund when it comes tax time. So again, kind of a yin and a yang. In terms of timing of benefits. The problem is that people sometimes will say, hey, I don't want to pay any tax, so I'm going to file exempt on my W-4, which again, the W-4 just is for your withholdings. It has nothing to do with your total tax payments. So even if you do file as exempt on your W-4, that does not mean that you're going to be exempt from actually paying taxes. That would be nice, but sadly that's not how it works. So yeah, if you file exempt on your W-4, you can fully expect to have no withholdings, per paycheck, and your paychecks are going to be a lot higher than otherwise would be. But when it comes to filing your taxes, assuming you have a tax liability, not only are you going to pay a year's worth of tax liability all at once, but you're also going to probably get hit with some underpayment penalties and interest, and that's not going to be as fun. But there are people out there that truly are, eligible to be exempt. Maybe they don't make enough, or maybe they have enough qualifying other credits or so forth that usually will knock out their salary to a point where it's non-taxable. And if that's the case, yeah, go for filing exemption. But again, just make sure that you're doing it right, because again, if you truly are going to be, liable for something, then filing exempt is probably going to hurt you in the long run, because again, they'll get you with those taxes and penalties. Personally, for me, the one situation I see the most of is like younger kids, like high school or whatever. You know, they're going out and getting their first job. They still live with their parents and they're still considered dependents. However, they are going to be working part-time, making a little something. Now, depending on the level of income and how much they make throughout the year, they very well are going to be exempt. There's just not enough to have any type of, tax liability there. But they still may need to report, file taxes, but in the end, they still may not have to owe anything. Now, going back to what I originally said, people just like to claim zero, which again is usually the more conservative, safe, route. But if a kid does this, then more than likely they're going to have, taxes withheld for which they really don't need to. And to add insult to injury, usually these kids don't go ahead and file taxes. So what's happening is all the money that's being withheld from their pay goes to the government, which really shouldn't have in the first place. And it just stays there. It doesn't go back, to this, to the rightful owner. So again, if you truly are, potentially going to be exempt, make sure you to file exempt, because again, that's going to be pay that you are entitled to, that's going to, revert back to you. That way you don't have to wait until you file taxes to get it back. But by the same token, if you aren't exempt and you do have to have any type of liability, try not to file exempt, because again, it can bite you really hard and really fast, and you don't really want that. Now that I just talked about kids not filing exempt and now the money, government not getting enough money, if I go missing after this video, just know that, I tried to do what I could. I don't know if the government's gonna be mad at me, so Godspeed. Ooh, number 8, where's my refund? I have absolutely no clue. You see, whenever we file your taxes, whether it's for the IRS or your states or whatever, once we send them off, they are out of our hands. Usually we don't have access to some secret portal or secret, chat log with the IRS agent that says, hey, here's exactly where your, refund is in the process. Usually once it leaves our office and we send it off, usually a few, hours after that, then you can usually go to what's known as like, where's my refund? The IRS has a page for it. Every state that has, income tax, assessed usually will have a page like that. You just enter in your information and it'll tell you pretty much exactly where in the process it is. So if you do come to us asking, hey, where is our refund? We're honestly just gonna look at the exact same web page that you could be looking at. So again, there's not like any secret information that we have that, that we know more than you. Again, once we file it, it's in their hands, it's not in ours. Now, we'll go ahead and mention that this is assuming that you are due a refund and you are wanting something direct deposited, because whenever you want something direct deposited, there is going to be some bank account information needed on the return. Now, that's assuming that it's your bank account information and not, say, the preparer, which is a huge red flag and a huge issue. Now, there are some unethical preparers out there that will say things like, hey, we can give you, a refund advance, or we give you like a loan against your refund before you get it, which in itself isn't the problem. But what happens if they go ahead and give you the refund, but in the part of the return where it actually has the bank account information, it's not yours, it's ours. So basically what's happening is they're taking your refund and, well, redirecting it back to them. This is where it gets a little crazy, because again, people do offer legitimate like refund advances and loans and so forth, which I'll be honest, I don't know really of any of my colleagues that do. This is more of like a niche or like a box store type offering. Again, your local preparers usually don't offer it because again, it gets pretty messy and pretty convoluted. So we usually try to keep our hands out of that. Because actually what happened is here in the past few years, there have been preparers that have done exactly that. They've given money to their clients, and in return, they went ahead and just put in their bank account information on the returns and filed, and they got all the the refunds. But what's happened is, thanks to COVID and you had all these stimulus payments and so forth, guess where the money went? Did it go to the client's bank account? No, it went to the preparer's bank account. And you can only imagine people were ticked when, again, you had so many people that were entitled to, again, stimulus money. And again, the IRS only had bank account information on the preparer, not the actual client. So again, if you are going to somebody that's filing your taxes and you are due a refund and you do want it direct deposited, make sure to take the extra step and maybe ask them, hey, can you confirm that's my bank account on there and not someone else's? Now, again, maybe they can have it so you have to sign off or like put like little initials by the bank information just to ensure that it's accurate, because otherwise, your money could go somewhere else, and which is obviously not what we want. All right, now, why do we ask so many questions? Because we pretty much have to. It's part of our due diligence. We pretty much have to ask exactly what's going on. And again, kind of going back to one of the first questions is, how do we know like what deductions or so forth we qualify for? We pretty much just have to ask, again, a lot of questions to really get an understanding of what's going on in order to take the appropriate steps. So again, like when it comes down to the days of just going up to somebody, your local preparer, and just saying, hey, here's my W-2s and everything, here's my shoe boxes of receipts, I'm pretty sure those days are over, because again, in order for us to have to do our due diligence and all this fun stuff, we pretty much just have to ask a bunch of questions to see exactly what occurred in order to, again, just do the appropriate, next steps and so forth. So again, in order to do that accurately, we do have to ask a bunch of questions, especially if you're a head of household. So again, you're unmarried, you have a child that you take care of, so custody, majority custody, whatever. So again, we'll probably have to ask you a bunch of questions on like, hey, can you like prove that you supported, the household? Do you have grocery bills, utility bills, real estate tax payments, rent, whatever? Also, can you prove the kid lived there? Can you show us school records or medical records or so forth? So again, it kind of opens up a can of worms. Again, we ask a bunch of questions regarding it, but again, it's just to cover our rear ends and yours too. And the sad reality is even though like family or close friends or whatnot that, I do taxes for, I pretty much have to go through the gauntlet with them for questions, just as if like you came off the street and asked for, tax help as well. So again, no one's immune to all the questions. It's just one of those things we have to do nowadays. Number 10 is, do I need a CPA? Well, not necessarily. It depends on what you're exactly trying to do. If you're talking about just strictly tax preparation, no, you don't have to have a CPA. There's another really big player in the game, and those are EAs, or enrolled agents. Now, this is a debate as old as time. I mean, we're talking prehistoric times, where which one's better, the CPA or the EA? It's a question that will probably never be answered in time, but in complete honesty, you probably couldn't go wrong with either one. We're both credentialed, we both have to take continuing hours, and well, I know EAs that could probably wipe the floor with me with their tax knowledge. So one's not necessarily better than the other, but again, it just comes down to, do you know someone who's reputable and maybe that's local? I do stress that local part because again, like where we live, taxes get pretty complicated, especially if you work in one state but live in another, because again, I'm kind of like on a border town. So having someone who's local, again, whether it's CPA, EA, whatever, as long as they know what's going on and how to do it, again, you should be fine either way. So do you really need a CPA to do taxes? Not necessarily. But by the same token, do you really need a mechanic to, again, change the oil in your car? Not necessarily, but again, it's something that we are trained to do. And more importantly, we have skin in the game, because again, if I go out and start committing tax fraud and so forth, not only would I potentially go to jail, I would lose easily my license, probably the first thing, but I'd probably be blacklisted from the accounting profession as a whole, which means I have to start over, my entire career life somewhere else. And quite frankly, I'm too lazy to do that. But at the end of the day, just find someone who's reputable, who probably is local, especially if you have, more like complicated state taxes or so forth. But again, just make sure you can have someone that is reputable and has, recommendations. Again, if they are credentialed, that's great. You can also check their credentials on one of these sites just to make sure that you're actually going to someone who says they are, because anyone can say that they're credentialed or whatnot, but it all comes down to, are they actually vetted and can prove it? And that's another question entirely. All right, are my home improvements deductible? More than likely, no. Now, granted, let's say you have an investment property or Airbnb and so forth, and you want to, put new flooring in and so forth. Even though you are going to be out money for, again, specific improvements to a house, it doesn't necessarily automatically mean it's going to be tax deductible. Now, when it comes to, again, like rentals and Airbnbs and so forth, things like maybe just, buying a potted plant or getting like different kinds of lamps to put around, since those are not essentially attached or fixed to the house, maybe they're just plugged in, those could potentially be tax deductions. But when it comes to actually like wiring, like, new ceiling lights, maybe new HVAC system, bigger purchases, usually those cannot be written off at once. They usually are going to be considered capital assets, which are going to have to be depreciated over time. Depreciate just basically means that you are out the money today, but the useful life of the asset or whatever it is means that you get to take a little bit of a cost, reduction or, write off, year 1, year 2, and then so forth. But the biggest situation I get asked this question is for people when it comes to their personal houses. So, their primary residence, they live in it, they don't rent it out or anything. So usually speaking, when you do want to, make improvements to the house, again, whether it's something minor like buying a painting, or I think I said like buying, table lamps or whatever, usually those cannot be considered deductible. But what if you want to like completely redo the landscaping, or maybe the siding on the house, a new roof, a new HVAC system or whatnot? If you do something like that, again, probably not going to be a write-off, but but easily could be considered a capital improvement for which it's going to increase your cost basis. So in the event that you're going to sell the house down the road, those improvements are going to help reduce your basis and any potential tax, capital gains that you may, incur. Now, that's not to say that any type of house improvements are going to be, without any type of immediate benefit. So for example, we have energy credits where if you buy certain, SEER level appliances or so forth, and you incur the cost in 1 year, you can potentially take some sort of credit that, same tax year whenever you file those taxes. So again, that's a little bit of a difference. It's not really in the same situation of, having to deduct it and take out, the benefit over time. But again, there are certain credits for like windows and, energy efficient doors where, again, those would be considered improvements, but you can go ahead and capture some sort of credit at the time of whatever year that you're going to be, filing the taxes. Now, taking it even one step further, let's say you want to get like a pool or something massive, kind of going back to like the medical expense question where, again, you need to lose weight, your doctor's recommending it, so you're going to go and buy a pool. Well, again, that's opened up a whole nother can of worms, but just for argument's sake, let's say we are going to be able to write off the cost of a pool. So pools are expensive. So let's say hypothetically it's $80,000 to, start and finish one. The thing is, your home improvement or your assessed value is going to change as well. So even though you spent $80,000, let's say the home value from before the pool was X, and now it's X plus 60,000. So after installing this $80,000 pool, your home value increased by 60. So can you deduct the full 80? No, it would be the only difference of the 20,000 here, which because at this point, this is really all that you're out. And this isn't just limited to pools. This could be like things like widening certain, hallways, or, installing, lifts or elevators into the house. Again, if you're assuming that, have a disability for which you need it. Again, now you're talking not only home improvements, but medical necessary expenses as well. But again, we have to look at it in comparison to the total of what is the house value before these improvements and after, because only the difference between what you paid out and the increased value of the property is actually considered the potential write-off in that situation. Next in line, we got what's the difference between short-term and long-term capital gains? Well, short-term is measured in inches and long-term is measured in meters. But in all honesty, it all comes down to the timing of when you hold an asset and you turn around and resell it. Short-term usually means less than a year, whereas long-term is a year or above. Now again, we're talking about capital gains. So again, this is at any time that you have an asset in which you purchase and then you hold on to for a certain amount of time and then you go and sell it. So for example, let's say I have this really rare book, signed by the greatest of celebrities, and I buy it for $100 and I hold on to it and I sell it for $300. Now the question is, what is my income? Is it the $300 I got? No, it's the $200 because again, I bought it for $100. That's my basis, my cost basis, and I sell it for $300. So my profit, or in this case, the capital gains, is $200. Now, depending on how long I held this book is going to determine if it's going to be short-term or long-term gains. If I bought this last week and I sold it today, that's obviously less than a year. So this is that $200 situation here is going to be booked to short-term capital gains. Likewise, if I bought this 3 years ago for $100 and I sold it today for $300, and same dollars, just different timeline, again, this is going to be subject to long-term capital gains. Short-term capital gains are interesting because they're taxed at the same tax rate as if, any ordinary income like you get from your W-2. Long-term capital gains, on the other hand, are taxed at lower tax brackets than, again, what we've seen through just our normal, normacy income. Which is interesting because you've probably heard the story that, Warren Buffett himself pays less in taxes than a secretary, which is somewhat true, but a little bit of a, missing point there. Because I can guarantee that Warren Buffett pays more dollar-wise than his, secretary. But the story comes into how the tax rates work. because the secretary is probably just making a salary and she's just going to pay the normal tax rates that either one of us would do if we had the same similar job. Whereas Warren Buffett, on the other hand, probably is getting paid mostly through stocks, and rather it's not much of a salary. So whenever they get stocks, they will have the cost value basis will be X dollars, but if they hold on to it for longer than a year and then sell it, and again, if it's over a year, it's going to be charged at a lower tax bracket than what the potential receptionist in this case is going to be charged to. Now you might be saying, is that fair? Well, that fair is subjective, but it all comes down to incentives. The tax law was written to incentivize people to have more long-term investments in order to buy something and hold on to it for longer. Whereas kind of the more comparison, way of thinking about it is if you buy stock and you sell it, a few days later, then you're really just kind of looked at as more of a day trader, which is just a normal job, which again, it probably has the same tax rates as in this case, are no more W-2 income. But people who hold on to investments for longer get a little bit of a nicer benefit of not having to pay as much in terms of tax rates because it's capped at 20%. Lucky number 13, do I have to report income that I've made through yard sales or garage sales or whatnot? More than likely, no. You see, when normal people have yard sales, it's usually just meant to get rid of crap in their basement or garage in order for, to free up space. It's not meant to derive and create income. Even though you are going to probably walk away with more cash than you started the day with, just because you have cash does not mean you made a profit. Again, if I had a yard sale and I wanted to sell this cup for, let's say $10, I'm sure someone will buy it. But the problem is these cost, maybe $30, $40. So technically, even though I probably will walk away with $10 more than I had before, I technically lost money because again, we purchased this for like $40, sold it for $10. So I lost $30 in that deal. And the sad reality is the IRS doesn't really care about personal losses that much. So any type of loss that we incur throughout the, the day of having yard sales or whatnot does not translate to savings that we can take as a deduction. So personal losses are not accounted for. And that's the same with anything that we're trying to sell. Again, we're usually just trying to sell things for cheap that we're trying to get out of the house. But the big thing is, as long as it's being sold for less than when we purchased it for, in the past, then it's considered a loss. So at this point, it's not considered income. And if it's not considered income, then there really wouldn't be income tax on something because it's not income. But if you buy something for, again, let's say this remote for $5, and I'm going to sell it for $20 for whatever reason, then obviously that $15 bump in value is considered income. So again, kind of like what we talked about a little bit earlier, that's a capital gain. And obviously capital gains are considered income because again, you're purchasing something for X and you're selling it at an appreciated value. So again, if you're like a content creator that I see quite often, that's like going to yard sales with, POV, camera and saying, oh, look at this, Nintendo Wii, they have it listed here for $10, but then eBay sells it for $80, and that's what I'm going to sell it for. You pretty much just put a target on your back because you're automatically saying that, hey, I'm going to buy something, I'm going to flip it for a profit. And if that's the case, then obviously you're in the, you're doing it for income generating purposes. So yeah, at that point, if you are doing it that way, you would be considered, paying tax on that income. But again, for us normies, whenever we have yard sales and so forth, we're not really trying to make any money. We just want to get stuff out of the house. And again, generally speaking, most of that's sold at a loss. And again, at that point, it's not necessarily considered income, nor do we get to take like any type of loss deduction anyway. So again, just enjoy your extra money that you generated and move from there. I did need to throw one little caveat before I went to the next question because I completely forgot about this. There are situations where people actually just hold yard sales and it seems like that's their job. If that's the case, like you go and you live in a neighborhood and you have a neighborhood yard sale, once a year, and you pitch in and volunteer, you participate that way, then more than likely you're not considered having a business. So again, that money you're getting is not usually considered income because you're selling things at a loss. But let's say you also live in that neighborhood, but you have a yard sale every other week and you just have so much stuff that how on earth are you accumulating it? Again, at that point, more than likely you're buying it for something and you're trying to sell it for more. If that's the case, then yeah, you're probably going to be seen as like self-employed, which again, you're probably going to walk into some taxes and self-employment taxes and so forth. When it comes to the frequency of having yard sales, that's also going to come into play because again, usually people just have it once every year, if that. But if you have it consistently where you have to go out and buy inventory in order to hold a yard sale, then you're probably looked at as a flipper and more than likely that income that you are generating is considered income and taxable. All right, I work from home, and can I take the home office deduction? Well, thanks to COVID, a lot more people are working from home nowadays, and well, it's a pretty valid question. As of right now, if you are an employee, meaning that you have an employer and you're paid through a W-2, even if you work from home, right now there's really nothing deduction-wise available. So I realize that just knocks out a lot of people from taking the deduction, but what if you're a self-employed or, contractor and you also have a home office? Well, you may be able to. You have to meet 2 tests in order to make sure that you can qualify for the home office deduction. The first one's pretty simple. It just says it's designated. Basically, it just says that you have a designated spot in your house or on your property or whatever that you have, again, designated for working. Now, this gets pretty easy if you have to have prints or maybe you have to meet with clients or so forth. So usually you'll have maybe like a desk with some chairs. You'll have a printer. Maybe you've got a laptop dock where you slam it down. It's got multiple monitors. You have all this stuff hooked up, and it's really hard to just move things around. If that's the case, then more than likely you can meet the designated test because, again, you've got stuff fixed in a location where, again, you can just come up and do the job from there. Now, as things get more technologically advanced, things get a little bit hairy. Let's say you can do most, if not all of your job just from your phone and a laptop. You don't need to print anything. You don't meet with anyone, personally. You do everything through Zoom. If that's the case, and well, if it's nice out, you'll probably work out on the front porch. If it's rainy, maybe you'll do it in the basement, maybe in the garage and watch the game, if it's something going on. If that's the case, then you really don't have a designated spot, so you kind of lose out on that test. So again, if you're looking to take any potential deduction here, you got to make sure you have a designated spot because, again, that's rule number 1. Now, rule number 2 knocks out a lot of people from being able to take the deduction because even though rule number 1 as designation was actually pretty simple, the rule number 2, which is exclusion, is much harder to meet. And the IRS takes it very seriously. Basically, it just says that your spot that you have designated is exclusive to your business, almost to the point of any personal activity or fun outside of business that happens in that confined area is considered exemption, and the deduction is then waived and no longer be able to take. My favorite story involving this is actually a colleague of mine who had a colleague or a client. I don't remember the connection, but long story short, there was a client that had a work from home attorney. Attorney had a huge, massive office, double French doors, 14-foot high ceilings and so forth. But the office was adjacent to this big living dining room area. And the family here was really into having parties. Well, when you had a lot of people coming in, there wasn't enough room to seat. So they would open up the office area and extend tables into that area so people could still have places to sit and still socialize. Well, you can guess that the attorney work had nothing to do with the feasting and, activities that were going on when, the tables were brought into the office. And for whatever reason, I can't remember why, but this situation was being audited or whatnot. And they found out that, no, you cannot take this deduction because, again, even though you do have a designated space, obviously, it was not exclusive to, the client work. So the moment this office space was used for just overflow eating, they took it and they said, no, you cannot take it as a deduction until you can prove that this space is exclusive to business. So let's say hypothetically you have a little home office and you work on the dining room table. Again, it's designated. That's where you got your papers and you got inventory kind of scattered out. That's where you fulfill your orders. However, once 5 o'clock rolls around, you shut the laptop, you clean everything up, and you start having family dinner on that same table. At that point, you don't meet the exclusive test. Even though you did meet rule number 1, it has to be exclusive. And like I said, the IRS takes it extremely seriously. Then and only then could you potentially take the home office deduction. And again, there's some more nuances. I actually have a full-length video on my channel. Just go there and check it out. I think it's 30 minutes, if not even longer. So again, quite a bit of detail to go over, but again, as long as you meet the designated and exclusive tests, then you potentially have a chance of taking the home office deduction. Oh, also, you can't be an employee currently. It has to be contractual or self-employed. Numero 15, can I rent out my home tax-free? Absolutely. Some people like to call it the Augusta rule. I personally like to call it the Ty Pennington rule. If you remember Ty Pennington, he was the host of a popular show called the Extreme Home Makeover Home Edition or something to the effect of that. It was real popular back in the late 2000s. I believe it's still around. It's got a different host. But basically the premise was a family in need would get a home. They, would send them off, they'd come back, get a new house, move that bus, and then, all the tears and all the happy faces from all the volunteers around the town come together, for that needy family. But I digress. Can you rent out your house tax-free? Because yes, you can, as long as it's within a 14-day period. So if you can rent out your house for 14 days or less, then the income that you derive from that renting out becomes tax-free. Which is crazy if you think about it, because there really is no limitation on the value of the rent. So if I have a friend that come over, for a week, and I, just charge them $20 per day, and that's the only time I rent out my house throughout the entire year, then that $20 per day is, tax-free. Again, as long as the total amount of days is less than 14. It doesn't have to be 14 consecutive days. It can be split apart. Now, taking it to the other extreme, I live around the area where the Derby occurs, where there's just this influx amount of people that come into the area, all looking for hotels that are booked up and so forth. So maybe I want to earn a little extra cash and start charging them like $3,000 a night to, stay in my house. And if I want to do that, again, as long as it's under 14 days, that $3,000 or whatever example I came up with is still tax-free. Now, going back to the whole Ty Pennington thing, because again, that's a really important little, side note, little tax trivia. Again, I got a full-length video talking about it, but basically it's built around the same tax law. You kick a family out of the house for, a few days, you bring some contractors in, you build up a new house, they come back and, they got a brand new house, right? But again, it all revolves around that whole Augusta rule, because again, they are renting out the house from the family for 14 or less days. The value of the incremental, value of the house and the family vacation and so forth is considered the rent payment. So yeah, if you ever think about, watching that show or like any of its many clones there are, it's pretty much the same premise. The family is renting out their house to the TV show, and the rent payment they're receiving in exchange for that is not necessarily the normal rent that you would have in a tenant and landlord relationship. It's, again, a new house, new furnishings, the vacation or whatever they're going on. Which is kind of cool if you think about it, because if you ever go back and watch these shows, if the family's vacation's, starting to come to an end, or, there's rain that delayed things, people are starting to get panicked, like, oh, the family's coming back. The whole issue is not the family coming back, because they got money to send them and to another vacation, if things get delayed. It's that 14th day, because if they go above that, then all that rent payment actually becomes taxable to, again, the family in need. And, it's usually a family in need that's getting the new house, so anything taxable to them, especially the value of a new home, incremental value of a new home, and vacation and so forth, is going to be very detrimental. So yes, if you want to get into your little bit of entrepreneurial spirit, or you want to, kind of dabble in some Airbnb, rent out your house for, again, 14 days or less in total throughout the year, and technically, according to the rules, it's tax-free. Next question is, do I have to pay taxes on any type of Venmo or PayPal or Cashapp or anything over $600? And the answer is probably, but more than likely no. You see, a year or so ago, this opened up a huge can of worms, and it got a lot of people angry, saying that if you use these third-party processors or whatever, and you make a total of $600 or more, then you're going to be issued a 1099K if I'm not mistaken. The problem is, now that you have a 1099, guess who also gets that 1099? The IRS. So now you have some sort of document that it's going to have to be reconciled to the IRS. So yeah, anytime you receive a 1099, it is going to be reportable. But just because you report it does not mean it's taxable. Because that brings up the next question. What exactly was the 1099K representing? A few questions ago, we were talking about yard sales, and some people just don't carry cash. So if you're selling stuff at a yard sale, which again, if you're not, meeting the, capital gains definition where you bought something, you're selling it for more, you're taking losses, even though you are coming out ahead cash-wise, you are not getting income, so there's no tax. But what if everyone that's coming to your yard sale is paying you through Venmo? Even though you may cross over that $600 threshold and you're still getting a 1099, just because you received it does not mean you have to pay tax on it. Because again, if that income that you actually got that's represented on that 1099K, if it's not income, you don't have to pay tax on it. But again, I did mention it has to be reported. So if you did get a 1099K, you do have to list it. Usually it's other income. So it's going to show up in your gross income or whatnot. But again, if the question becomes, if the money that you received from that, Cashapp or whatever was not considered a taxable event, like it wasn't income, then it can be reduced by that same amount. So let's say, for example, we go back to the yard sale where, again, all these Gen Zers are coming up to my property and buying stuff out of my garage, but again, none of them are carrying cash. They're all using Venmo. Well, next thing you know, I have $1,000 in Venmo credits, and well, now I got a 1099K from Venmo saying, "Yep, you made $1,000." But again, I just sold everything at a loss. I have no income from that $1,000, but I do have to report that $1,000 as income. So the $1,000 shows up as income, but a little bit lower on that tax form is a way to adjust your income. In this way, you're actually going to be removing it. You'll have a little bit of a spot for, an explanation. Generally, you would say something like non-taxable income or reimbursements or debt payoff or something. So that way you can identify, yes, I did get a 1099K, but I'm also going to adjust that same dollar out because, again, at this point, it's not taxable. So do you really have to pay taxes on 1099K income? Not necessarily. Is it income? Yes. If it's not, no. But do you have to report it? Yes. If you did get a 1099K, it still has to show up somewhere on your, to show up on your tax return. But by the same token, if it's not income, deduct it out. Oh, this is a good one. Why can't the IRS just send us a bill? It's a very valid question, but the problem is if they do just send us a bill, more than likely it could be incorrect. You see, when it comes to your tax liability or your tax story or whatever you want to call it, your income is only just one part of it. You see, it's not only your income, but it's also your filing status, any type of qualifying deductions you qualify for, qualifying credits and that. And in the reality, the IRS really only knows the income portion, maybe, of this equation, not these other three. So if the IRS doesn't know about this other part that plays together, then why would they send us a bill if it could potentially be incorrect? So when it comes to things like W-2s and 1099s, not only will you get a copy, but the IRS does as well. So again, that would be the reportable income side of the equation. But what about income that's not reported? So if you do have other income that's not reported on either of those forms, then that's something the IRS doesn't know about either. But in reality, the IRS doesn't really know right off the top of her head if we're married or if we got divorced, if we have a kid or more kids, more tax credits, child tax credits from that direction. And more importantly, if you get paid with a 1099, that's usually just representative of your gross income, not necessarily any deductions that go against it. So for example, if I worked for Uber and I made $10,000, all got paid with a 1099, well, the IRS could send me a bill based on $10,000 worth of income from, contractual work. But what about my mileage? I have other costs that go against that 10,000. So we shouldn't be paying tax on, that amount. It needs to be what we actually are netting. And see, that's the whole purpose of filing a tax return, is because, again, the IRS does know something to the effect of, okay, we have your reported income and that puts you in this tax bracket or whatnot. And well, here's your tax liability. But again, it's all these other things they don't know about. So again, that's the whole purpose of filing a return, is because you want to be able to show them, oh, these are deductions I can take. These are credits that I qualify for. So instead of owing, $10,000, maybe my tax liability is only like $6,000. And again, that's something they won't know. My favorite story involving this that illustrates this even further is if you sell a house. You see, if you sell a house, more than likely you're going to get a 1099-S for the proceeds of the sale of the house. So if you sell a house, you're probably going to be getting a nice chunk of change, whether it's $100,000, $200,000 or plus, especially in today's environment. So again, same situation. If you receive a 1099, guess who else gets it? The IRS. But see, there's this thing called a Section 129 exclusion that says if you lived in your primary house for any 24 of the previous 60 months, then you can potentially qualify for an exemption based on your filing status. Now, at least where I live, we really don't see any gains that go above this exclusion because, again, house prices, at least in our area, is relatively low, nationwide. So a lot of people, if they qualify for this exclusion, don't pay any capital gains tax because, again, their true gain is still under those exclusions. But the IRS doesn't know that we meet those exclusions unless we file a return. So what has happened a couple times with new clients, getting a letter that almost gives them a heart attack is, well, they sell a house, they get a 1099 for, say, $200,000. Again, that's not necessarily the amount of gain, it's just the proceeds. But again, the whole reason for a return. So a client opens up a letter and says, hey, it's a letter from the IRS saying that you owe tax on $200,000, which is going to be substantial. And since it was missed on your prior return, that, whatever the tax is, it already has compounded some penalties to it. So you can only imagine some of the fear calls I get from, new clients that say, hey, my prior preparer passed away or retired, and we just got this letter and it's outrageous. What do we do? Well, it's sometimes fixed with just a simple phone call or amendment. But again, it highlights that the IRS just sends bills based on what they know about an income. More than likely, it's going to be way overstated. And the sad reality is people usually don't question these letters or whatnot, and they just pay them. When again, more than likely, it could be overstated. So, yeah, I'm all for making the whole tax process simpler, but just having the IRS send bills may not be the most efficient use at this time. Again, I could be wrong. All right, so how will my second job affect my taxes? Well, this is a really good question because thanks to inflation, well, a lot of people are working side jobs or opening up little, working part-time, doing self-employment and all this fun stuff. So a lot more people are working more jobs. And well, the bad part of that is people are getting shocked, not in a good way when it comes to tax time. You see, here in the US, we have a marginal tax system. Marginal just means incremental. So anytime you're talking about a second job, you need to think about it marginally or incrementally. So in this case, if you are working a W-2 job, it's your only source of income. You withhold 10% of your, paychecks, and that's enough to generate a $1,000 refund. Again, just making up numbers every year, and you're satisfied with that, great. But once we start adding in a second job into the equation, we can't use that same percentage because again, now that you're adding more income, especially supplemental income, we have to look at it from a marginal tax rate, not so much an effective tax rate, because again, now that new income's coming into play, we need to make sure that we're withholding at the marginal tax rate of that new money, not our current money, because again, it's going to be averaged low, and I'm probably not making any sense by saying this. So again, you have to look at it from a marginal standpoint. So if you are working another job, you have to separate those in your mind that you've got your normal, that's again, keep as is, if you're satisfied with it. But anything extra is going to be looked at from the lens of your marginal tax rate. Again, ignore all this, and that's how you're going to have to withhold. So again, going back to the example I was kind of talking about, if you make $50,000 a year in your W-2 job, and that's the only source of income you make, well, you make $50,000, you reduce it by your standard deduction or whatever, so you're really only paying tax on, let's say, about $40,000, maybe 30-ish thousand, whatever, and you get a refund of $1,000, But now that we're taking this new job and we're making, let's say, $20 an hour, but we are now in the 12% tax bracket. So for example, let's say we started picking up a second job and we're making $20 an hour. Now, we're currently in the 12% tax bracket. So now we got to look at these $20 per hour at 12% as our new focal point, our new run rate, whatever you want to call it. So for every dollar you earn at your new job, you need to have withholdings of at least 12% in order to stay flat, or at least move in the right direction from where we were down here. Because again, if we're used to having $1,000 of refunds year after year, again, we can use that as kind of a baseline, because in order to keep that 1,000, that means any supplemental income needs to be withheld at our new marginal tax rate. And this is where people get really tripped up, because let's say we're doing just we've been doing your taxes for quite a while or whatnot. You've always had just one source of income, let's say through a salary job, and your effective tax rate was always like 9%. So you were always used to having 9% of your pay withheld for federal taxes. You always had a little bit of a, refund. So we knew that 9% was was sufficient enough to, cover any type of tax liability. But now that we're adding any type of new income on top of it, 9% isn't going to cut it, because there is no tax bracket that's 9%. So again, any new income that's coming in the door has to be withheld at your marginal tax rate for those new dollars in order to stay ahead of the game. Obviously, if you want to withhold just a little bit more, obviously that's going to help, with any type of potential refund. But again, it comes down to the marginal tax rate of those new dollars, because that's what's going to actually, keep you ahead and not have to, owe a bunch when it comes to tax time. Now, add another level of insult to injury, because if you are self-employed, expect another 15.3% in self-employment taxes on top of your net earnings from, again, whatever, side job you're doing. So for example, if I started doing, guitar lessons out of my house and I make, $10,000 from that, however, I incurred, $2,000 from just expenses of just, operating, doing music lessons. That means I'm going to be taxed on $8,000, but I'm in the 12% tax bracket, so that $8,000 needs to be withheld at 12% Oh, but it's also going to be considered self-employment, which means it's going to be 12% plus another 15.3% in order to, again, be sufficiently covered when it comes to, income taxes. And that's just federal income taxes. So also include your state rates as well in order to, be covered with theirs. But yeah, you'd be surprised at how many people learn the hard way when it comes to just how taxes work when you start adding on new income, because again, a lot of people think of just how they're withheld at like their standard job is sufficient enough, which again is never, well, rarely ever the case. Again, we have to look at it marginally. So again, each new dollar, what's that tax bracket? And at that point, you're thinking more correctly. Next is, what is the best way to give you my tax documents? Now that we're in a much more technological advanced, age here, the days of actually, submitting tax documents electronically is being more and more, I guess, common. The problem is that there's still some unsecure channels in which I'm doing so. So if anyone says, hey, you can just email me your tax documents or just take a picture on your phone and just text it to me, these are huge red flags. Absolutely not. Again, not a secure and a safe way of transmitting sensitive information. Generally, when it comes to tax work or actually any type of financial work, usually there's going to be some sort of portal that you can log into if you have an account. And there's going to be some like secure feature that sends everything encrypted, back and forth. And that is probably the best, if not the only way we should be doing things electronically when it comes to transmitting, tax documents, especially anything with social security numbers and bank account information. Now, me personally, I use TaxDome as my portal. I've also used something called Drake portals or Secure File Pro. I know some people use things like Canopy. There's some really nice ones out there that are, intertwined or interconnected with whatever tax softwares that we use. Which again, if you want to make sure that you're using a good one, just make sure that you're maybe read up on reviews and see if they're being, used by actual credential, tax pros. Things like, again, like I was saying, like just sending things through email or through a Dropbox or Google Drive usually are not going to be as secure as they need to be. So I would probably be a little bit leery of using those. Again, something that has an account that you have to set up and again, offers some sort of encryption, file upload template or whatever is going to be the preferred way to do it because again, that's just how things are going to be moving and we just got to keep your information secure. Now that's just talking about the electronical side of things. What if you still want to have, actual physical papers and you want to, bring it up? Well, same thing, just make sure that you are actually maybe delivering it to somebody. Now, things like mail drop boxes and so forth are still pretty popular. Heck, I'm probably going to install one in this building. But again, just to err on the side of caution, it's always good to actually leave those documents with a physical person. Obviously, the better would be the person who's actually going to be signing off on the returns, like whoever is owning the, the tax business or whomever, or if they have like a receptionist leaving it with, them or her or him or whatever. But just taking tax documents and like putting it in somebody's mailbox or maybe like under the floor mat of, the door, whatever, not the safest thing to do. Now, if you're a little bit leery about submitting tax documents over electronically, don't worry, you're not the first and you certainly won't be the last. But as the whole tax career and processes continue to evolve, the whole idea and implementation of electronic transfers is nothing new. And again, as long as it's going through it like a secure portal, one that's reputable, then you're going to have to be safe. And it's going to be encrypted. There's insurance covered by the preparers for those type of things, and as well the vendor as well. But again, as long as there's some sort of secure portal, you should be safe. Oh, number 20, we're out of the teens now. Will donations reduce my tax bill? Yes and no. So when it comes to donations or charitable contributions, they are a part of the itemized deduction pool, meaning if you remember back from earlier questions that if you choose the standard deduction, then you miss out on all the itemized deductions that have been, compiling. So, for example, if you attend a church or whatever and you do your tithing and offerings every week, however, even if you add all those up together along with all the other eligible, itemized deductions, if this total amount doesn't surpass the standard deduction that you're qualified to take, then everything here just gets everything you did incur in terms of your donations or whatnot do not get counted as a deduction because, again, it didn't get counted in the itemized because at that point it wasn't beneficial. Now, donations and charitable contributions have to be to qualified, recipients. They can't just be to the homeless person you saw on the street or maybe, or a family or friend, had maybe a pet pass away, so you decide to give them some money. Even though it is kind in gesture, it's not considered a charitable contribution, so that's not considered a potential deduction. Usually you want to make sure that whoever is going to be receiving the money is a 501c3, which again is an IRS designated, agency classification that you are considered a qualified nonprofit. As long as the funds are going to them, that is considered, again, a donation, and that would begin to qualify for, again, any potential deductions for donations. And also keep in mind, anytime you're donating anything other than cash, it's going to be the fair market value of whatever that asset is, not the original cost that's going to be potentially be deducted, which does sometimes get people messed up. So for example, let's say I have a car. Now, I bought it 10 years ago at $10,000. It was a good car, but right now it's a piece of junk. I mean, it's a clunker. It probably will not start here, but I want to give it away. Now, the Kelley Blue Book says $500. Now, that means if I do donate it to a qualified charity, say, I don't know, maybe there's a charity that like fixes up cars or whatnot. If I donate the car to them, do I get $10,000 of deduction or do I get $500? Well, it'd be $500. Because again, anytime you're giving something that's non-cash, it's the current fair value of whatever that is at the time that you're giving it up, not regardless of when you actually purchased it for. Which reminds me of a story of one of the very first tax returns I ever did. And it will probably always stick with me, and it's always a good learning lesson. Client was a single mother. I don't remember how many kids, but same thing. She went ahead and got rid of her car. Same situation, purchased it years ago for thousands of dollars perhaps, but right now it was just a piece of junk, not doing anything, hardly worth, just the metal that was even, in it. Now, she got her tax advice from her hairdresser or whatever that said, hey, if you just give your car up, then you'll get the full value of that you purchase price as a credit, which is wrong in two stance, because no, it's not the value of what you originally purchased, and it's not a credit, it's a deduction. So this lady gave up her car thinking that she's going to get $10,000 back for donating a car that was worth $500, which wasn't the case. So yeah, this lady went ahead and gave away her car. That again was worth $500, but again, that $500 was added to the itemized pool. It was not enough to surpass the standard deduction, so everything that's occurred here was just, forgotten, dissolved, because it didn't matter. So in the end, she pretty much gave her away her car for nothing because she thought she was going to get $10,000 back as a credit, not a deduction, but a credit. So she thought I was going to be writing her a check for $10,000, I guess. So in the end, not a fun conversation to have. So again, when it comes to donations, it's part of the itemized pool. If it surpasses your standard deduction, great. If not, you're probably going to be missing out on it. And more than likely, if it is something that is non-cash, again, it's the fair market value of whatever, value of, regardless of what you paid for it. 21, should I file an extension? Well, it really depends. Whenever you file an extension, it moves the filing deadline from April to the fall. Now, one thing to remember, that only extends the deadline of the filing requirements, not the paying. So if you do have to usually owe taxes each time you have to file a tax return, just because you file an extension does not mean you get to get another 6 months of reprieve from having to, pay taxes. Anytime you file an extension, generally you have to have some sort of estimated payment, assuming that you are going to owe something, just to help cover any type of liability you have once the filing has actually been performed. Now, technically, when it comes to extensions, some preparers will say, if you come to me anytime after March 1st, you automatically get a extension, just because, sometimes we get so backed up that anything after March automatically gets extended, just to be safe. But again, which is kind of a counterintuitive, because in order to understand your potential tax, liability and any estimated payments you need, we'd have to do some of the tax return anyway to get an understanding of what you could potentially owe, which means if we're going to go ahead and do it to get an estimate, we might as well go ahead and finish it out, meaning that an extension may not even be warranted unless we still get it in before mid-May. March, April. So if you don't think you're gonna get your tax returns done by middle of April, go ahead and file an extension. But again, if you think you're going to owe something, you might as well go ahead and figure out some sort of estimate on what that could be. That way you can go ahead and pay it. So whenever you do file your return later down the road, if you were incorrect, you can potentially claim some of that money back. Next up is, what's the difference between a marginal and effective tax rates? So marginal tax rates are the same as tax brackets. You see here in the U.S. we have a handful of them. They range from, I guess we can count 0% to up in the 30s. And what marginal tax rates or tax brackets represent is each dollar that falls in this bracket is taxed at that percent. So for example, let's say you make $50,000. You're going to have some portion of it that's going to be taxed at 10%. So this portion is 10%. This next portion is going to be the next tax bracket, which is 12%. And as we continue to make more and more money, then the amount that's in that bracket, in this case the 12% bracket, continues to grow. And then once we hit the top level of the 12% bracket, then we move to the next bracket, which is 22%. So all in all, in total, you're going to have some money that's going to be taxed at 10%, some at 12%, some at the next bracket if you're still within it. So what happens is that even though you're in the 22% tax bracket in this situation, that doesn't mean all of your income is being taxed at 22%, because again, you still have some at 10, you still have some at 12%. So these lower amounts start to kind of average what your effective tax rate is. And that's what an effective tax rate, it's what you actually pay out in terms of, your tax liability. Because again, your marginal is just basically your tax bracket that's just steps up every time you hit, a certain level threshold, depending on your filing status. Whereas your effective tax rate is basically just going to keep edging along just as a smooth line as you continue to make more, because again, as you make more, you're gonna make more within that bracket, and that's going to overall start to kind of increase the average of what your tax rate is. Now, because of how the math works out, I personally have never seen a part where the effective tax rate is greater than your marginal tax rate. I don't want to say that never happens, but truthfully, I've never seen it. And just in doing, tax planning and, simulations and so forth, I've personally never seen it, so I don't think it's possible, but again, it potentially could. Because again, if let's say you're in the 12% tax bracket and you just got into it, you just got a little bit of a promotion and you just moved from the 10% bracket to the 12% bracket. Even though that means every new dollar that you're earning is going to have to be taxed at 12%, the first batch of, money that you've earned is going to be taxed at 0 and 10%. So your effective rate is going to be somewhere in, let's say, the 9% range. So in this situation, your effective rate is, say, 9%, but you're in the 12% tax bracket. As you earn more, you're still within the 12% tax bracket, but that 9% effective rate is starting to creep up as you continue to make more. And then there comes a point where effective is going to get pretty close to your marginal, but then the marginal is going to kick up to the next bracket. And as you can guess, as you continue to make more, your effective starts to increase even further. Now, in order to figure out your effective tax rate, all you need to do is look at your tax liability and divide it into your taxable income. So let's say hypothetically you have a tax liability of $10,000 and your taxable income is $100,000. Then your effective tax rate is, 10%. Now, even in that little simple example I gave, that your effective tax rate is 10%, even if you have a $100,000 of taxable income, that's going to be putting you in the 22% tax bracket if you're filing jointly. So in this case, you're in the 22% tax bracket, but you're effectively actually only paying 10%. Now, taking it a step further, I like to use what's known as a modified effective tax rate. I'm sure there's another term for it, I just haven't learned it yet, because here's the reality. When working with clients, they sometimes don't automatically know what their taxable income is. They only know what their gross income is. So if you're a single person making $50,000 a year, then you know that you're making $50,000 a year. But if I was to ask, hey, what's your taxable income? Well, you may say 50,000, but that's not right, because it would be 50,000 minus your standard deduction, potentially, depending on what that is. Is it single? Is it head of household? You're not married, so it's got to be, one of those two. What other deductions do you qualify for? Because even though you made $50,000, your, taxable income may be $38,000. So if I'm working with a client and their effective tax rate is, say, 10% when it comes to dividing into their taxable income, I also like to give them that same percentage as a function of their gross income, because usually that is a little bit more meaning to it, because they can at least visualize it better. So in this case, if someone's making $50,000, their effective tax rate normally is 10%, but if we divide it into their $50,000 gross income, that 10% is going to go down to maybe, let's say, 7%. So that tells the client and myself that, hey, when we look at your income going forward, as long as you're making that same amount, you should be withholding at 7% in order to, be breaking even. Anything above 7%, again, assuming your income stays flat, that's going to generate potentially a refund. However, as you continue to make more, that 7% or 10%, however, whichever denominator you use, is going to increase. But yeah, learning the difference between marginal and effective tax rates can be a little tricky, because again, your marginal is just your tax bracket that you're in, whereas your effective is what you're actually paying. But again, depending on what you use as your denominator to figure out what the effective tax rate is going to change, how you should be thinking about how to do tax planning and so forth. But again, the big thing to know is that your effective tax rate will continue to increase steadily over time, whereas marginal, just boom, just as soon as you hit new brackets. Oh, last but not least, will I go to prison for messing up my taxes? Some people have actually sent me some TikToks about this, and they're actually pretty funny, but obviously going to prison isn't funny, so I should probably, preface that. But the reality is, are you really going to be going to prison if you mess up your taxes? And the chances are, well, probably not. You see, when we're talking about individual taxes, if you mess something up and the IRS or any of your states capture it, what's going to happen is you're going to get a letter or notice that says, hey, here's miscalculation, or something doesn't match up. We received this 1099, but it's not reported on your return, so there's a discrepancy there. So again, you're going to get a statement. If you ignore that statement's going to turn into a second statement. It's going to be a little bit more aggressive. And again, at that point, you have an opportunity to respond and so forth and, maybe get things right. If you ignore that second notice, then you're going to look into the realms of tax liens and wage garnishments. Now, personally, for myself and any type of clients I've ever worked with, usually that's the end of the story, because tax liens and garnishments will take care of your tax debt. And once the tax debt is, finished and taken care of, then, well, there really is no opportunity or incentive or reasoning to go to jail. That's not to say that there's some instances out there that individuals will go to prison for, completely falsifying, but usually that's at the point of they somehow evade any type of garnishments and warrants and all that. Now at that point, yeah, we're probably talking prison, but honestly, for myself and anyone I've worked with, I've never personally seen it. I'm sure there's stories out there, but I think it's extremely rare. Now, a group of people that I have heard been going to prison for falsifying tax returns are the preparers themselves. Not you as clients, who are doing DIY work, because again, at that point, sometimes you would just fix it when you start getting letters, but people who are doing it for a living or whatnot that do falsifying records and so forth. There are actually plenty of instances of us going to jail. So what are the chances of you going to prison for messing up your individual taxes? Probably pretty slim, because again, when we say mess up, that usually means unintentional. However, if you are committing fraud, which means that you are knowingly committing, falsifying records and so forth, maybe that kind of changes up the story a little bit. But again, liens and garnishments are usually what takes care of that, at least from my perspective. But again, when it comes to, actually going to prison, I feel like it's much more likely, we'll be going to prison rather than, you. And that was 23 of some of the most popular tax questions that I've received in the past several years. So I hope that was helpful. Hopefully you learned a little something. And well, until next time, happy taxing.